I get this question a lot. I'm Lynette Moore, local mortgage broker in Ontario for residential mortgages. Clients ask me, what's the difference between fixed rates and variable rates? And when I tell them that the fixed rates are based on the bond market, I get blank stares back. So this question comes up all the time. I just want to explain it maybe a little bit in a more understandable fashion. So it comes up all the time. Here's a version that makes it clear. Okay, so the simple explanation is think of the bond market like the seesaw, and it helps set the fixed mortgage rates. So banks and lenders don't base fixed rates on Bank of Canada's overnight rate. That's the one that affects the variable mortgages. So they look at something called the Government of Canada bond yields. So basically the interest the government pays when it borrows money for 5 years or more. That's those, you can Google them. I'll put a link here that you can go and see how the bond yields fluctuate like minute by minute. So it's not like the variable rate that is the same rate until the Bank of Canada announces a new overnight rate. So when an investor thinks the economy will slow down, they buy more bonds for safety. So this pushes bond yields down, and then the fixed rates usually drop. So when investors expect growth or inflation, that's when they sell the bonds. So yields go up and fixed rates rise. Variable rates follow the Bank of Canada's overnight rate, which changes about every 6 weeks. The fixed rates follow the bond market, which moves daily based on investor expectations and the economy. So a simple analogy will be the variable rates follow the Bank of Canada's mood every 6 weeks, and fixed rates follow the market's feelings about the future every single day. Hope that helps a little bit. Reach out if you have questions about your fixed mortgage or your variable rate mortgage and what options you have there.